This is Wall Street Week. I'm David Westin, bringing you stories of capitalism. This week, why so many U.S. pharmaceutical companies make their drugs in Ireland, and whether President Trump can use tariffs to change that. Plus, the irresistible force of government subsidies meets the immovable object of Harvard. And using the IRS for all sorts of things other than collecting money. How much it could cost us all. But we start, once again, with the Federal Reserve.
The risks of higher unemployment and higher inflation appear to have risen. If the large increases in tariffs that have been announced are sustained, they're likely to generate a rise in inflation, a slowdown in economic growth, and an increase in unemployment.
And we turn to our special contributor, Larry Summers of Harvard, for a reaction.
I thought the chairman handled the difficult situation correctly. Look, he has a real problem. Policy is pursuing a supply shock that we are inflicting on ourselves. We're pushing up prices with the tariffs, which is a path to inflation. In response to that, monetary policy normally hits the brakes. We're sucking purchasing power out of the economy and creating huge uncertainty that potentially is chilling spending. In response to that, monetary policy traditionally hits the accelerator. It's kind of a trick that we've pursued policies that have made expected unemployment and expected inflation go up at the same time. It's not a good thing to have done, but faced with both of those effects, not knowing which one is going to be larger, not knowing what the size of the shock is going to be, not knowing what the effects of the uncertainty is going to be, I don't see how the Fed had any viable alternative but watchful waiting.
The Fed said explicitly just exactly what you did, which is the risks of inflation have gone up and the risks of unemployment have gone up, which really goes to the dual mandates. And Chair Powell did his best to dance around that. But as a macroeconomist, if in fact you end up with inflation and higher unemployment at the same time, and you have to choose between the two mandates, does history tell us which you should choose?
So this is a rare situation that the Fed finds itself in. Look, I don't think there's a hard and fast rule. I think the balance of opinion would be among economists that the Fed first obligation is to the price stability mandate, because if you let inflation go, you're going to have higher inflation expectations, and that's going to risk higher unemployment down the road, almost for sure, as you try to achieve disinflation.
The one constant it seems we have right now is uncertainty. We heard about it from the Fed, we hear about it on Wall Street, we hear about it from companies as they report their earnings, uncertainty, and it pops up in all sorts of ways. What do you make of what happened with the Asian currencies in the last week? I mean, like, for example, the Taiwan dollar went up more than it had done in decades.
My instinct is that the Taiwanese situation, because of the national security aspect, because of how much the currency had been pegged, is because of aspects of the hedging behavior, is somewhat unique. So I don't think it would be right to see it as a precedent for multiple other moves that are going to take place. But I'm not certain of that, and I'm very much aware that there are huge foreign holdings of treasuries at this point, that the other side of that flow into U.S. treasuries, that what enables other countries to buy all those treasuries is the dollars they're accumulating, because in toto, they're exporting more to us than we're exporting to them. But I don't think the contradiction between hating the trade deficit and loving the capital inflows is entirely clear in the mind of the administration. I have not heard the Secretary of the Treasury thoughtfully address the question, if we scale back trade deficits, which after all is the repeated and constant emphasis of their policy, how are we going to have the capital inflows that are necessary to keep interest rates bounded, that are necessary to accumulate all of the debt that we are mounting? So my guess is that this Taiwan situation is sui generis, but it is indicative of a much broader kind of challenge that we face with capital inflows and trade deficit. The one thing we know is that we can't fully resolve that trade deficit just as a matter of arithmetic without also reducing the foreign capital inflow into the United States.
President Trump has been pressuring the Fed to cut rates, which the Fed chair, Jay Powell, has resisted. Larry's fellow Harvard economist Ken Rogoff was the chief economist at the IMF, and his new book, Our Dollar, Your Problem, looks at the link between Fed independence and the strength of the dollar. We've heard from the chair, Jay Powell. One of the concerns going into this was the independence of the Fed, given some of the remarks from the President of the United States, Donald Trump and others. Did Jay Powell help restore some of the confidence in the independence of the Fed?
Well, he's definitely held the line, and Trump has retreated at the same time. But he's just been very professional, kind of ignoring Trump and, saying the truth. Tariffs are going to cause higher prices and lower output. Trump might not want to hear it. I mean, to be fair to Trump, every president tries to get the Fed to lower interest rates, or 99% of the time. But I think where he is crossing a line is saying, well, I'm going to fire him. That's just self-destructive. He's shooting himself in the foot. I mean, that said, Fed independence is not as sacrosanct as people think. I'm amazed how many educated people I talk to who think the Fed's in the Constitution and you can't do it. It's not. It's a creature of Congress. There have been various acts of Congress, but 1913, it's when it started. If Congress were in cahoots with Trump, they could literally make it disappear in a week, bring it back under the Treasury.
We have a tendency right now to think everything is because of Donald Trump as president. As you point out in your book, the dominance of the dollar actually may have peaked like in 2015.
Exactly.
There are larger forces even than Donald Trump afoot here. What are the consequences of a relative decline in the dollar as against other currencies?
So first, the fact there are larger forces is significant because, if he backtracks and somehow convinces everybody to forget that it happened, the rule of law is fine, we're not going to arbitrarily put tariffs and this and that, we're still in a period of dollar decline. So the consequences of it are, first, we'll pay a higher interest rate. Now, we probably pay between 0.5% and 1% less than we would if we weren't so dominant. It's not just that the dollar's the most used, it's way the most used. And to be clear, that doesn't mean we're paying less than Germany, because we borrow a lot more than Germany, so it's sort of controlling for what we're borrowing. And that applies to mortgages, to car loans. It's a big deal. So
if the United States were to come together as one, just bear with me now here on a counterfactual, if we were to come together as one and came to Ken Rogoff and said, our priority is making sure the dollar does not continue its decline, what would you advise us to do?
Well, I mean, the simplest thing for short term is preserve Fed independence, which I do think is under duress in a lot of ways. Don't do the tariff war, which absolutely accelerates the process. When you restrict trade, you're putting sand in the wheels of the global financial system. When trade can't move freely, it affects finance. Since we're the kings of finance and we benefit from that, that's not a great idea either.
Coming back to Jay Powell, chairman of the Fed, and what he had to say this week. Basically, the Fed told us the risks have gone up of both inflation and unemployment. Are we headed to stagflation?
Oh, I think it's very likely. I mean, that's the base case here, that The hard numbers are not so bad. They're mixed, but not so bad. I mean, the jobs report was amazing. But, nevertheless, if you look at business confidence, consumer confidence, global confidence, and some of the more forward-looking measures, it certainly looks like if we don't quite go into recession, we're going into something that'll feel like it. And just, the arithmetic of the tariffs is it's going to raise prices. So near term, yes. Now, is that a one-time thing or not? It's not. It's hard to know what behavior will be. I mean, I think the Fed's a little bit worried that this is coming on top of what just happened, where people were told, except by Larry told you, but people were told, this is temporary, it's transitory, it's going away, one-time thing. Now the tariffs are coming. Oh, it's transitory, it's temporary, one-time thing. Well, you're not going to believe them. And wage setters, businesses. So it's a difficult period for sure for the Fed. And stagflation's the most likely outcome. And Powell kind of said that without coming out and saying it.
Up next, the politicization of the IRS. President Trump has a lot of plans for America's tax service, but they don't appear to have much to do with actually collecting money for the government. That's next on Wall Street Week.
You're listening to Bloomberg Wall Street Week with David Westin from Bloomberg Radio. This is Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is a story about biting the hand that feeds all of us, and at a time when we're particularly hungry. The IRS is the federal agency charged with collecting taxes from all of us who owe them. And though we might not enjoy paying our taxes, there's little doubt that the government needs the money right now. President Trump has made cutting the deficit a priority for his second term in office, and he proposes to do that in part by cutting back on government agencies.
We have cut billions and billions and billions of dollars.
One of the first agencies to be hit with some of the deepest cuts has been the Internal Revenue Service, an agency of the Treasury responsible for collecting taxes. Its predecessor was a federal office once called the Commissioner of Internal Revenue, created in 1862 to fund the Civil War with the country's first income tax.
Most people think of the IRS in terms of an agency of taxes. When you say IRS, that's what they think about, right? It is filing a tax return, paying taxes, and getting a refund. And how much is my refund going to be? And how quickly am I going to get that refund?
Chuck Rettig was IRS commissioner in President Trump's first term.
That dynamic right there literally touches 100% of the American tax-paying public, which is large corporations, small corporations, it's small businesses throughout the country.
As important as it is for the IRS to make sure the government gets all the revenues it's entitled to, it has historically fallen short.
The IRS is responsible for collecting about 97% of federal revenues. So the money that funds everything, that funds our defense, that funds our roads, that funds our schools.
Natasha Sarin is a professor at Yale Law School and president of the Budget Lab, which calculates the fiscal impact of federal policy proposals.
Historically, the IRS has been able to collect about 85% of taxes that are owed. So that means that every year it loses out on about $700 billion in taxes that are owed to the government but not collected. That's a lot. That's about 3% of GDP on an annualized basis.
Why has the government been going without revenue amounting to 3% of its GDP each year? Experts say it's simply a lack of resources.
It has never had the resources. For decades and decades and decades, it has been an underfunded, underserved organization. It doesn't get a lot of talking support from anybody on the Hill, not in terms of the nature of the IRS itself. So people will use the IRS for other game plans. So when the IRS does get funding, Congress tells us exactly how to spend every one of those dollars.
You had an IRS that over the course of the decade between 2010 and 2020 had lost in real terms about 30% of its budget.
The Biden administration tried to remedy the problem, working with Congress to give the IRS more resources to get the job done.
Congress invested about $80 billion in the IRS over a 10-year period. And that over a 10-year period is actually super important because when you think about things like, hiring and training a bunch of revenue agents who are capable of doing complex partnership return work, or when you think about modernizing outdated technology, those are investments that don't pay off immediately.
When I was on board, August 16, 2022, Inflation Reduction Act, we got $79.6 billion of supplemental funding. And of that $79.6 billion, they appropriated $45.6 billion to what's called compliance or enforcement. And the significance of that $45.6 billion was Treasury ran the numbers and said, well, IRS, if we give you $45.6 billion for enforcement, you will be able to recover $700 billion. That's their math. That was never my math. And IRS never spoke and said, give us this and we'll recover that. I always said, with more funding, we'll be a better agency across the board. That gave Congress the ability to go spend $700 billion. So if you will, giving us 45 was a pay for other things that Congress wanted to do.
The hope was that by investing in the IRS, revenues would grow more than the expense of more agents and better technology. But as of now, it looks like that will never happen.
You've seen a bunch of those investments rolled back. So already of that $80 billion, the IRS lost $20 billion of enforcement dollars that were really focused on improving tax compliance. They were rolled back as part of the debt ceiling agreement last summer.
So in 23, they took away $20 billion from enforcement, and then just in the last round, took another $21.4 billion for enforcement.
We have 4 years.
Now the Trump administration has moved not only to reverse giving the IRS more resources, but to cut them below what was there before, including cutting staff by as much as 25%, with a fair number of staff already let go.
In terms of workforce cuts, right, the high for the agency, there was about 102,000 employees last year. With deferred resignations, with getting rid of probationary people, as well as normal attrition. So let me touch the attrition issue. When I was on board, we averaged 83 to 87,000 employees, but about 55,000 of those employees were eligible to retire within 3 years. Thankfully, most IRS employees stay 5 years after they're eligible to retire, but it's an aging workforce. And there was a hiring freeze from 2011 to 2018. And so you lost an entire generation of experience, if you will, that you would bring in, and you have an aging workforce. And then in the current environment, they've been encouraged or told to leave the agency.
The IRS has lost about 7,000 probationary employees at the agency. And I think probationary is like kind of a misnomer of a term because it implies like someone's on probation or some such. That's actually not the case at all. In fact, these are individuals who were either recently hired and recruited by the IRS to do some of this like very difficult work that they historically haven't been able to invest in, like partnership audits, where today the IRS's audit rate is like literally 0%. So they hired a bunch of people who have expertise in these areas. And what they also did is they promoted people. They moved people into new roles. And because they're relatively new in these new roles, they're probationary employees. About 7,000 of these people have already been let go from the agency, and there have been plans for reductions in force that would total like 50% across the board, which would bring the IRS to levels it hasn't been at since the 1960s, when the population was 60 million people fewer. You've seen a very significant exodus from the IRS of senior level leaderships, but really across the board. And about 22,000 employees have already taken the deferred resignation plan that's been offered, which means that by the end of this year, even without any additional reductions in force, you're going to have an IRS that's 30% smaller than it was at the beginning of this year.
I think we will come to judge when we observe the consequences of tens of thousands of IRS enforcement personnel being let go, and it being done in a way where because of the incentive scheme, the most competent people, the people who can get the best jobs elsewhere, are the ones who are most likely to leave. I think we are threatening the basis of our tax system, which is based on voluntary compliance.
So is there any way of calculating how much this will cost us at least in lost revenues that we otherwise would have had.
My colleagues and I at the Yale Budget Lab have concluded that just the workforce reductions that have been planned thus far are likely to cost the IRS somewhere between $400 billion and $2.4 trillion over the course of this next decade. That's like a very large range. And so what is driving that? Well, the dollars that are going to be lost aren't just direct dollars, like you do fewer audits, and as a result of that, you collect less taxes. Certainly that's going to happen. And great work by Nathan Hendren and Ben Sprung-Kaiser and their co-authors says every $1 spent on high-end enforcement by the IRS generates 12. So incredibly high ROI work that we're not going to be able to do. But you're not just losing direct dollars. If there are traffic cameras on the road, people drive the speed limit more often than not. And the same is true with the tax system. If there is an infrastructure in place and people know that the IRS sits ready to pursue noncompliance, they're more likely to play by the rules. People are going to adjust their behavior and not play by the rules as often, and also take tax positions that are really quite questionable.
If President Trump really wants to make progress on that deficit, it looks like cutting costs at the IRS may be the last place to look, not only for the taxes we won't collect, but also for the signal it sends to those who didn't want to pay the taxes they owed in the first place.
I do believe you're going to see aggressive tax planning. I think you're going to see tax professionals who prepare returns are telling me people are coming in saying, well, why do I need to file the return?
Or have been found.
We have a president who's completely delegitimizing government and who's taking away the capacity of the IRS to process tax returns, to audit when that's necessary. I think we'll see many more people take cash payments and not report them. Many more people engage in dubious transactions with their cronies to misvalue assets and avoid paying taxes. Many more people engage in abusive tax shelters. That's an area the president, I think, has some awareness of from his past business dealings. And when all of that happens, the people who are going to pay are honest taxpayers. I'm working on this pretty carefully right now with some colleagues. I'd be surprised if we're not on a path to sacrificing more than $1 trillion of revenue over the next decade because of this misguided, wanton attack on the IRS. And that's going to make our fiscal problem worse, or it's going to force us into other kinds of damaging tax increases. It would be much better to do a better job of collecting the taxes that are levied under current law. It would be better not to be driving the economy from above ground to underground in terms of American competitiveness. So I don't think we've seen large consequences yet from all of this, but the risks are very big.
Coming up next, President Trump complains about all those U.S. pharmaceutical companies making drugs and money in Ireland. What took them there in the first place? And can Trump tariffs get them to come home?
You're listening to Bloomberg Wall Street Week with David Westin from Bloomberg Radio. You're listening to Bloomberg Wall Street Week with David Westin from Bloomberg Radio.
This is a story about competing for the business. Every government cuts sweetheart deals to attract companies' business. But can it go too far? President Trump says Ireland's done just that, especially when it comes to U.S. companies manufacturing pharmaceuticals.
The EU was set up in order to take advantage of the United States.
Including Ireland? Is Ireland taking advantage of the U.S.?
Of course they are. But the United States shouldn't have let it happen.
Whether it's taking advantage of the United States or not, the facts show that Ireland is winning more than it's losing in the competition for American business.
So the Irish story with corporate tax and multinationals is probably a 5-decade-long story, at least at this stage. Particularly since we joined the European Union, it's been a real differentiator having a low corporate tax rate.
Ireland's Investment Promotion Agency, the IDA, reports that more than 90 pharmaceutical companies operate in the country, and many of them are U.S.-based. All of this is no coincidence. For the companies, Ireland offers a range of advantages, and one of them is its sweet tax arrangement, part of a long-term Irish plan to attract foreign direct investment. Danny McCoy is the CEO of the Irish Business and Employers Confederations.
We're looking at an FDI model that's built on certainty and longevity. And I think that's been really significant in the last decade in terms of the flight of capital towards Ireland as a result of the OECD corporate tax work. Big brands like Intel, Apple, and Pfizer have a history here. In the case of Intel, they're nearly newbies at over 40 years. Apple's been here since 1980, and Pfizer are probably the best part of a century in one form or another. So longevity and the very big brands have been co-located here in Ireland long before the corporate tax world that we've entered into in the last decade.
I think there's many different reasons why, both why they set up shop initially and then also why they've continued investment in Ireland and continue to expand in Ireland.
Jennifer Duggan is Bloomberg's Ireland bureau chief.
I think certainly there were a number of tax incentives initially there to really entice international companies to come to Ireland. And I think that probably started a lot of that initial investment. But I think there's a number of things that, has helped Ireland continue to attract investment.
The Irish strategy to use taxes to compete for foreign investment went into overdrive during the great financial crisis.
When the global financial crisis happened, we were part of an IMF ECB bailout. When I first joined the government in 2011, we had 14% unemployment, we had a massive budget deficit, and we were able to turn that around. And we mainly turned it around based on the traded sector of our economy. And that was producing goods and services that we could sell to the world. And US firms were a big part of that.
Leo Varadkar was Ireland's Prime Minister from 2017 to 2020, and then again from 2022 to 2024. How material to the fiscal situation in Ireland has been, if I can say it, the extra money from corporate income tax?
It's been a huge help. It's a big part of our tax base, larger than would be the case for most developed countries.
Corporate taxes make up close to 20% of total government revenues, most of which comes from U.S. multinationals. But it wasn't just the Irish government's business-friendly policies that got us to where we are. The U.S. did its fair share to drive away business.
I think really the role of Ireland as a major center of tax policy or of tax sort of goes back to the 1980s in some form, but it really gets going in the late 1990s and early 2000s.
Alex Arnon is Director of Policy Analysis at the Penn Wharton Budget Model.
One of the key changes there is on the U.S. side, is the introduction of what's called check-the-box regulations. Essentially, it made it easier for U.S. multinationals to manage their overseas operations. And so this change in U.S. regulations combines with some very specific attractive features of the Irish tax environment. Starting in the 1990s, they dramatically reduced their corporate tax rate down to about 12.5% by 2003. Ireland also has a lot of bilateral tax treaties with other countries, which makes it easy to manage the relationship between your subsidiaries across those countries. So the combination of those U.S. policy changes, the Irish tax environment, and then some features of Ireland as an economy that made it attractive.
This isn't the first time that President Trump has focused on Ireland's success in luring U.S. businesses. His Tax Cuts and Jobs Act of 2017 tried to address at least some of the problems.
When we look at the Irish royalty payments to other countries, before 2019-2020, you see the vast majority of these payments are going to tax havens. That's Bermuda, the Cayman Islands, the Netherlands, Luxembourg, Singapore. And then starting in 2020, we see a very sharp crossing of the pattern, of the trends here, where royalty payments to these tax havens fall off a cliff, royalty payments directly to the U.S. shoot up. And often this is interrelated with some of the changes in the Tax Cuts and Jobs Act in particular the deduction for foreign-derived intangible income.
I think we are vulnerable. Ireland is a small country in a very big world, and we've done very well because of globalization. It's one of the things that's helped us to become a wealthy country and has allowed us to increase our standard of living considerably. So a less globalized world is going to be less favourable to Ireland economically. But I'm not as pessimistic, I think, as maybe others are. The United States is certainly now going in a direction which is protectionist, and that's definitely going to be a negative for us. But at the same time, the European Union, 27 countries, 400 million people, is doubling down on free trade.
Now, President Trump is once again focused on Ireland's big attraction for U.S. pharmaceutical companies. But this time, the tool he wants to use isn't taxes, but one of his favorites, tariffs. If your single goal was to get U.S. pharmaceutical companies to make more onshore in the United States, would you use tax policy or tariff policy?
Obviously, tariffs are a form of tax, but really here, the much more important component is the corporate income tax policy. If what we were talking about was a deeply considered, well-planned out, long-term strategy for predictable tariffs on pharmaceuticals, that might be a different story. That might start encouraging some major multinationals to rethink how they have arranged their activities around the globe. If it's what we have been seeing in practice from the Trump administration over the last few months, very hard to imagine really any big corporation making major long-term decisions on that basis. It is just too unpredictable, and that is really the biggest factor there.
I don't see it being a doomsday situation where suddenly all of US pharma and tech companies move out of Ireland. I don't think that's something that's going to happen overnight, but it certainly has the potential to damage Ireland's economy and also its attractiveness to future investment as well. Ireland has the second largest exports to the US from the EU, only behind Germany, and most of that is from the pharmaceutical industry. If US companies start to invest less in Ireland or start to move even small parts of their production back to the US, that would certainly have an impact. It's not something that's going to happen overnight, but as we see going forward over the next 5 years, the rest of the lifetime of this administration, it is something that we could see gradual changes.
It is hard to imagine what they will actually come out with would be enough to really prompt major shifts in the long-term planning and activities. There's a couple other wrinkles in there. Ireland has an exit tax for intellectual property. So if a major U.S. manufacturer of pharmaceuticals did want to, move some of their valuable patents out of Ireland back to the U.S., they would have to not just get more benefit than they're losing from what they currently have in terms of their strategy. They would have to be enough to offset this exit tax that Ireland will levy, and which they have specifically to prevent this sort of thing.
Ireland has seen change coming and has provided for it by investing the revenues it has enjoyed until now.
Ireland has one of only 2 trade surpluses within the EU. Being open to foreign direct investment and multinationals, I think, has brought a lot of multiculturalism to Ireland as well, and really helped propel Ireland in its development in terms of just to be more diverse, more progressive. So there's a number of different ways that it's impacted from an education perspective as well. It's
been a huge help. It's a big part of our tax base, larger than would be the case for most developed countries. And we've invested in infrastructure in particular, and that will continue. But we've also thought ahead. While it might have been tempting to ramp up public spending by much more than we did, we haven't done that. So the government for 2025 anticipates running a budget surplus of just under 3% of GDP. There might be a fall off in the amount of corporate tax revenues that come into the Irish Exchequer, and that's why we've paid down our debt, why we are running substantial government surpluses, notwithstanding a lot of political pressure back home to spend more on just about everything. And we've also established some future sovereign wealth funds, putting aside money for future pension and care liabilities, and also things like the cost of climate action into the future as well.
And in the competition for the U.S. pharmaceutical business, Ireland has a lot going for it beyond favorable taxes.
The investment pipeline still remains very strong. A lot of U.S. companies investing in Ireland, a lot expanding their operations. I think because of the geopolitical changes that are happening and the changes in the rules of tax and trade, we mightn't see the same level of new investment in the years ahead as we saw in the past. But I'd certainly be optimistic that those, big pharma, big medical devices chip operations will continue to operate, there's going to be a market for these products and a growing and expanding market for these products, not just in the US, but in other parts of the world as well. And bear in mind, we're part of the European single market, a market of over 400 million people, and the European Union has a network of free trade agreements with lots of different parts of the world. I'm confident those operations will continue.
International businesses trust Ireland, and they've got a history and a record to prove it.
We've seen Ireland's economy bounce back and really recover, and international presence of major companies has certainly helped that.
In the end, what the United States does to compete for pharmaceutical manufacturing will depend in large part on one man, President Trump.
I think what we don't hear enough about is the bilateral relationship. It used to be very one-way. But now Ireland invests a lot in the US. We're the 6th biggest investor in the US, which isn't bad for a small country of just over 5 million people. And depending on how you count it, there's somewhere between 100 and 200,000 Americans across 50 states working in Irish-owned companies. But certainly there is a focus on tax. And one thing I would say to President Trump, and I met him many times, is that if there is an issue around tax laws, it's probably more of an issue with American laws than our laws. The anomalies that maybe exist in the law are probably more on the American side. And in fairness, he's acknowledged that. He said that we've been very smart in our tax policies. We've always expected at some point that the US would change theirs.
That does it for us here at Wall Street Week. I'm David Westin. Join us next week for more stories of capitalism.